Imagine waking up on your 65th birthday, ready to finally hang up the suit, only to realize that the $1 million nest egg you spent 30 years building is actually worth less than half of what you thought in real terms. It's a chilling reality for many, and today we're uncovering the silent killer of wealth that targets you after 40. Most people believe that as long as they contribute to their 401k and pay off their mortgage, they're safe. But there is one specific mistake, an invisible trap that quietly destroys wealth during your peak earning years. It isn't a stock market crash or a bad investment. It's far more subtle and much harder to detect until it's too late.
After age 40, you enter a danger zone. This is typically when your income is at its highest, but your expenses also tend to peak. The mistake we are talking about is the fixed income mindset in a variable world. You are planning for a future using today's math, and that is a recipe for a financial catastrophe. Let's call this mistake the lifestyle lock-in. It happens when every raise, bonus, or promotion is immediately absorbed by a corresponding increase in your standard of living. By the time you reach 50, you've built a life that requires a massive monthly cash flow to maintain, leaving no room for the volatility of the real world.
Lifestyle creep isn't just about buying a bigger house. It's the microscopic expansion of your daily standards. That daily artisan coffee or the premium streaming tier seems insignificant, but over 20 years, these small leaks become a rushing river that drains your potential investment capital. It is the silent erosion of your future freedom. When you are in your 40s, you feel invincible because the paychecks are steady. But this is exactly when inflation begins its most aggressive assault on your purchasing power. If your expenses are rising at the same rate as your income, you are effectively standing still while the ground beneath you is slowly sinking away. The math is brutal. $100,000 in 2004 had significantly more purchasing power than it does today. If you plan to retire on a fixed sum based on today's prices, you are ignoring the fact that 20 years from now, the cost of healthcare, energy, and food could easily double or even triple, leaving your nest egg hollow. Another layer of this wealth-destroying mistake is tax inefficiency. Many professionals over 40 funnel all their savings into tax defer accounts. They think they're saving money now, but they are actually creating a massive tax debt for their future selves, one that will be collected when tax rates are likely much higher than today. Consider the case of Dave. Dave earned $200,000 a year, lived in a beautiful suburb, and maxed out his 401k. He felt successful. But because he didn't account for the one mistake, he found that at age 62, his overhead was so high that even a small market dip forced him to sell assets at a loss just to pay his property taxes. Dave's mistake wasn't spending money on stuff. It was committing to fixed costs that he couldn't easily turn off. When you're over 40, your financial flexibility is your greatest asset. By locking yourself into high-maintenance lifestyles, you are trading your future freedom for a temporary sense of status among people who aren't even watching. Psychologically, we are wired to seek status. In our 40s, this often manifests as keeping up with the Joneses at a professional level. You buy the luxury SUV because your peers have one. You join the expensive club because that's where the successful people go. But every status symbol you buy is a brick in the wall of your financial prison. This is the hedonic treadmill in full effect. As you earn more, your expectations rise, and you never feel richer. You just feel more pressured to maintain the new baseline. To break this cycle, you must consciously decouple your self-worth from your spending habits before you hit your 50s, or you'll be running until you collapse.
Beyond lifestyle, the one mistake also involves asset allocation. After 40, many people become too conservative too early. They move into safe bonds that don't even keep up with real-world inflation. Being too safe is actually one of the riskiest moves you can make because it guarantees a loss of purchasing power over the long haul.
The global economy has changed. The traditional 60-40 portfolio, 60% stocks and 40% bonds, is struggling in an era of high debt and volatile interest rates. If you are blindly following the advice your parents received in the 1990s, you are navigating a modern storm with an ancient map that no longer shows the hazards. So, how do you fix it? The first step is radical transparency. You need to conduct a forensic audit of your spending over the last 24 months. Identify which expenses are fixed and which are variable. Your goal is to keep your fixed overhead as low as possible, giving you the agility to pivot when the economy shifts. We call this the gap strategy. The goal isn't just to earn more, it's to widen the gap between what you earn and what you spend. Every dollar in that gap is a soldier working for your future. If your income goes up by 10%, but your spending stays the same, you have just exponentially accelerated your path to true financial independence. Next, you need to diversify your tax buckets. Don't put everything in a traditional 401k. Look into Roth conversions, health savings accounts, and even taxable brokerage accounts. Having money in different tax buckets allows you to choose which one to draw from in retirement, minimizing the bite the government takes from your life savings. Another critical move after 40 is addressing the longevity risk. People are living longer than ever. Your retirement plan shouldn't just last 20 years. It might need to last 40. This means you need assets that offer growth, not just preservation. Real estate, high-quality equities, and even small business interests can provide that essential edge. Many fail because they view retirement as an end date where they stop being productive. This is the ultimate psychological mistake. The wealthiest retirees are those who transition into a second act, a low-stress, high-enjoyment business or consultancy that keeps cash flowing in and keeps the mind sharp and engaged. Side income in your 50s and 60s is the ultimate hedge against a market downturn. If you can generate even $2,000 a month from a passion project, that's $24,000 a year you don't have to pull from your investments when the market is down. It preserves your capital and gives you peace of mind. Let's talk about debt. After 40, your goal should be toxic debt elimination. This isn't just credit cards, it's any debt with a high interest rate or a variable term. Entering retirement with significant debt is like trying to run a marathon with a weighted vest. It's possible, but it's unnecessarily painful and increases your risk of failure. The one mistake is essentially a lack of intentionality. We drift into our 40s and 50s following the path of least resistance. We accept the promotions, we buy the bigger houses, and we assume it will all work out because that's what successful people do. But true success is the ability to walk away from the game on your own terms. To avoid this, you must become the CEO of your own household. Set quarterly financial reviews. Treat your family's balance sheet with the same rigor you would a Fortune 500 company. If a cost doesn't provide a clear return on investment, either in happiness or future security, it needs to be on the chopping block. One of the most powerful things you can do right now is a lifestyle audit. Ask yourself, if my income dropped by 50% tomorrow, how long could I survive? If the answer is less than 6 months, you are in a high-risk lifestyle. The goal of the wealthy is to have a burn rate so low that even a catastrophe is merely an inconvenience. Remember, the biggest expense in retirement isn't travel or hobbies, it's the missed opportunity of the money you spent on things you didn't need during your 40s and 50s. That $50,000 car upgrade didn't just cost $50,000, it cost the $300,000 it would have become if it were invested properly. This isn't about living a life of deprivation. It's about living a life of priority. It's about choosing a stress-free future over a high-status present. When you hit 60, nobody's going to care what kind of car you drove in 2024. They and you will only care if you have the resources to live with dignity and choice. Don't be Dave. Don't let the silent thief of lifestyle creep and fixed income thinking rob you of the best years of your life. Start today by looking at your fixed costs and asking, is this purchase serving my future self or is it just serving my ego? The answer to that question will determine the quality of your retirement.
We've covered a lot today, from the danger of inflation to the status trap and the importance of tax diversification. Wealth isn't just about what you earn, it's about what you keep and how much freedom that keep provides you. You have the power to change your trajectory right now, no matter where you are starting from.
Take a moment today to look at your accounts. Be honest with yourself about the one mistake. Small adjustments made in your 40s have a massive impact 20 years down the line. It's the law of compounding, and it works just as well for your habits as it does for your money. Make sure your habits are compounding for you.
The road to a secure retirement isn't paved with luck. It's built with intentional, informed decisions made right now. Don't let the one big mistake destroy everything you've worked for. Hit the subscribe button for more deep dives into wealth preservation and check out our next video on tax-free growth strategies. Your future self will thank you for taking action today.